Hey, it's 12 noon on Wednesday, which means it's time for this week's episode of Ask the Instructor. I'm John Christmo. The show is brought to you by the Tampa School of Real Estate. We're going to be talking about interest today and understanding your mortgage payments, so don't go anywhere. I'm John Christmo. You're watching Ask the Instructor.
You are watching
Ask the Instructor every Wednesday at 12 noon Eastern Time. I'm John Christmo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. Every Wednesday, 12 noon Eastern Time, we come to you live into your homes, into your phones, or whatever device it is that you're watching us on, the small screen or the big screen, to help you get a better understanding of the technical side of the real estate industry. And today we've got a great topic to cover on calculating interest. And specifically, we're going to be working with compound interest, but this could be used in a lot of different methods. So we're going to be dealing with calculating interest and explaining and demystifying this whole interest calculation. When you understand this, you'll be able to do it not only for a mortgage, but for credit cards, for personal loans, for any sort of financing where they charge an interest. You'll be able to easily understand how it is that they're coming up with that number. So that's our goal for today. But before we get into that, let's talk about why we do this show every Wednesday at 12 noon Eastern Time. Ask the Instructor. We do this to help our students understand in the most detail possible these different concepts. You know, the pre-licensing course, you learn a lot of information when you take that course to get your real estate license, but that's still the tip of the iceberg of the information that's available and out there for you to know and understand in the real estate industry. And the whole kind of knowledge is power. The more you know, the more it is that you can thrive and prosper in the real estate industry. So for that reason, every Wednesday, 12 noon Eastern Time, we help you get a better understanding with this. And we don't just limit this to our students. Anyone that's interested in the real estate industry, in a real estate career, can tune in, watch the show, whether you're watching it on Facebook, you're watching it on YouTube, on our Success Center. If you guys are tuning in right now, be sure to hit like and share this with your friends, family, other colleagues, other realtors, whoever it may be that you think would benefit from knowing how to calculate interest. Let's rewrite that. Got to practice. I've been working on my handwriting. I'm not a scripter. Gotta slow myself down and it'll look good. So calculating interest. Now, there's some components you need to understand an interest. And we're going to put this in the context of a mortgage so you can understand how much that percentage of interest equates to as a dollar amount. But it's really not that complicated. So there's a few pieces of information that you need. Number one, you need the loan balance. That's one of the most important parts. You can't do this calculation if you don't know what that loan is. And for doing these calculations here, you could project some sort of loan balance. You could pick some sort of number if you want to get an understanding or understand how much more it is. We're going to be working with some numbers with that, but you're going to need the amount financed, the loan balance. And that's the easiest way to put that, is the amount financed. A lot of different words they may use to describe what these are. So you take your loan balance. The next number you're going to need is the APR. And pretty much any sort of interest is going to be expressed as an APR. And now you may have seen this term. I guarantee you, in the world that we live in with all the financing that's out there, you've seen this term APR before. And you might even know what it stands for, and it stands for annual percentage rate. So percentage rate, pretty self-explanatory. It's a percent number that we're dealing with here. But this annual number is really telling, and that's going to really help demystify a big misunderstanding when it comes down to interest. But other than that, once you have these two numbers here, the calculation is going to be fairly simple and straightforward. So let's say that we have a $100,000 loan. So if we took out a loan, whether it's a mortgage, whether it's some sort of financing, it's all calculated the same way with compound interest. You take that loan amount, you're going to multiply it by whatever the APR is. So let's say, and we'll fill in these numbers up here. So our loan balance, $100,000. Let's say our APR is 4%. So before we can multiply this, we do have to turn this into a decimal. So that's 2 decimal places over. We'd end up with 0.04. That's going to be our decimal for this. And then we're just going to go ahead and multiply down here. 100,000 times 0.04. And when we calculate that out, you probably don't even need a calculator. If you do, don't feel bad. It's $4,000. So $4,000 is our annual interest. Now, when you get a pill, typically with most of the financing that's out there, whether it's a mortgage, whether it's a credit card, whatever personal loan or whatever it may be, it's typically compounded monthly. And they recalculate this number. Compounding is a fancy way of basically just saying recalculating based off of the current balance. So let's say you took out this loan for $100,000 at 4% interest. That means when your balance is $100,000, your annual interest is going to be $4,000, but you're not going to have that $100,000 for an entire year. If you were only making annual payments, then that would be your interest amount. That would be how much dollar amount it is you'd pay in interest for that first year. But when this is compounded monthly, what you'd be doing essentially is taking this $4,000 and dividing that by 12. So when we pop that in our calculator, we take the $4,000, divide that out by 12, we get roughly about $333.33. So on this $100,000 mortgage, $100,000 loan, whatever type of financial product it is that we're dealing with here, if it's a 4% APR, annual percentage rate, the annual interest is $4,000, but when we pay this monthly, we need to break this now up into a monthly number. $4,000 is going to be over the course of the year, so we're going to divide that by 12. We get $333.33. Now, what we're going to be doing next is called amortization, because unless you're making interest-only payments. So there's a lot of different financial products out there, and it can get very confusing. And whether that's you as a consumer going out there and trying to obtain some sort of loan, some sort of financing, and you're just having a hard time making sense out of all this. I mean, it's funny, when I consider any sort of financial product or anything like that, you know, I'm breaking out a spreadsheet, I'm doing a bunch of calculations, and especially if I'm comparing options, I'm crunching all these numbers in there because it is somewhat complicated, if not very complicated, to find out what that true cost is of obtaining the credit and what this number looks like and what ultimately is going to work out better for you. So one of the options is an interest-only loan. So an interest-only loan means basically you're going to carry this $100,000 balance and you're just going to keep having payments required of $333.33. Now, as long as you're paying off that interest every month, this number is never going to change there. But we're going to basically be stuck in limbo. We're going to indefinitely having a $100,000 balance on our loan and never pay that down. And that's the whole big thing with mortgages and whatnot is, oh, you pay down over time and then eventually you own the property. With an interest-only loan like this, you're not ever going to eventually own the property unless you're paying more than whatever that interest may be. And typically, if you haven't paid anything more, let's say this is a 10-year loan, it's a 10-year term. That word term just means the time period. We're not using that here for the calculation, but just in case you see that anywhere, that word term means the time period associated with this. So if this is a 10-year loan, then you're going to be paying $333.33 every month for 10 years, and at the end of 10 years, you're going to have $100,000 due. And that's how the interest-only loan works. Now, most loans aren't interest-only because you could see how that might apply in some circumstances and it might make sense for certain people, like maybe some sort of investor, somebody who's planning on selling the property before that time period is up, before the 10 years, 15, whatever time period it may be, if they're going to sell it before that's up. That would maybe make sense if they're going to do the interest-only and just carry that balance and never pay down that balance anymore. So that's an option to consider there. But with most mortgages, you're paying more than this. You're paying more than this, and the reason why you're paying more than this is so your principal balance will decrease month after month after month after month. So let's throw in some additional info here. Let's say that our payment is I will do, for the sake of easy numbers here, we'll do $633.33. That's our monthly payment. And that's what the lender quotes us. Okay, this is how much we have to pay monthly. What we would do if this was our monthly payment and the only two aspects of our payment were the interest and the principal, which we're going to talk about what that principal means in just a second here, what we would do is subtract out that $333.33, and what we would be left with is a $300 payment. Principal payment, that is. So we're writing the check for $633.33, but the first people to get paid, the first people to collect money are the bank through their interest, through the fine, whoever's loaning this money. They're taking their interest first. The money that's left over is now going to decrease this $100,000. So when you get your next month bill, this $100,000 that you got in month one is no longer going to be $100,000. In month two, that $100,000 will have been decreased by $300. So your month two bill would be $99,700 instead of $100,000. And as this balance decreases, every time the balance decreases, this interest number is going to get recalculated. That gets recalculated out. You take, again, whatever that new balance is. So for the next month, we would take $99,700 times 4%. We'd get a slightly smaller number. Divide that by 12, a slightly smaller number than this. And we're going to continually be growing the amount that we're decreasing that balance by. We're going to walk through some steps of doing that. But before we do that, we're going to take a quick commercial break. Now, while we're on the break, again, this is a live stream. So send in your comments, send in your questions, anything it is that you're unsure about interest and mortgages or anything like that, put that in the comments. I would love to address your questions and concerns. But other than that, stick with us. We'll be back in about 2 minutes. I'm John Chrismo. You're watching Ask the Instructor. Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Did you know that if post-licensing education isn't completed by your first renewal, your real estate license will become null and void? If your license becomes null and void, you must restart the licensing process all over again. At the Tampa School of Real Estate, we make renewal requirements easy. Visit postflorida.com to learn more and enroll today. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com. Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo. The show is brought to you by the Tampa School of Real Estate. If you're thinking about starting or enhancing your real estate career, give us a call. Phone number is 813-928-0106. Again, that's 813-928-0106. You can also check us out at tampaschool.com. What we're talking about today is calculating interest and understanding your mortgage payment. A big expense. This is usually some of people's number one expense is their housing expense. Whether they're renting or whether they're making a mortgage payment on it, this is usually the top number. If we're going to organize everything, all their monthly bills and expenditures, the mortgage is really number one. And if you guys have any questions on this, again, make sure you put those in the comments. I want to give a quick shout out for Jake. Thanks for tuning in and watching. But yeah, if you guys have comments on any of this stuff, any of this math here that you don't quite understand, send that in so I could really kind of tailor this show to you guys that are tuning in today. And I've got both YouTube and Facebook loaded up on here, as well as our Success Center, so feel free to stick those comments in there. So what we just did, just to walk us through this one more time here, is we did a calculation of a $100,000 loan at 4% interest. That was 4% before we turned that into a decimal. We then took that 4% interest, multiplied it by a $100,000 loan balance, and we ended up with a $4,000. But remember that's our annual number, that $4,000. So you're on the right track, because you would think, okay, interest is a percentage. If I want to find a percent of something, I take that percent and multiply by whatever I'm trying to find the percentage of. And if we want 4% of $100,000, that is $4,000. But remember, this is an APR, an annual percentage rate. Not a monthly percentage rate, an annual percentage rate. And we now have to translate this into a monthly number when we're doing the math based on paying monthly. There's really not much financial products out there, if any, that have where you pay just annually. It's not enough security for the bank. They like that reoccurring money coming in. So we're going to divide that by 12. The $4,000, that's our annual number. We divide that by 12, and then we end up with our monthly interest number. And that's calculating interest. And that little bit that we just went through right here will work anywhere, whether this is a mortgage, and like how we're doing it here, this $100,000 could have been a personal loan. This could be your previous month's balance on your credit card. This could be for any sort of financial product. That's basically it. And even knowing how to do this, I can't tell you how many people I've talk to that don't know how to calculate just out what that interest is. And really the only tricky part is remembering it's an annual number. You divide it by 12, and then other than that, it's actually very simple. So it's a real simple, easy calculation to do, but I'd say probably 90% of the people in the world, if not more, don't know how to do that. So absolutely know how to calculate that interest so you can see how much it is that it's costing you for this money, whether it's a credit card, whether it's a loan, a student loan, a mortgage loan, whatever type of financial product it is you're dealing with, that's always going to hold true. Or if this was paid weekly, we wouldn't divide it by 12, we would divide it by 52. If this was compounded or calculated weekly, it's supposed to be a 5 there, we would divide that out by 52. Whatever that time period, that term is, if we're paying this monthly, we divide by 12. If it's weekly, we divide by 52 because there's 52 weeks in a year. If we're paying this daily, we would divide it by 365. So you just take whatever it is that you're paying it by and divide it out there. Now, before we went on break, we started talking a little bit about amortization. And amortization is basically getting an understanding of how much we're decreasing that $100,000 starting balance. So, okay, month one, our balance is $100,000. And if we were paying that interest-only loan, if this is an interest-only loan, that's never going to decrease. But most loans are not interest-only. Most loans are going to gradually kill off or gradually decrease. That's what the whole mortgage and amortization words, the root of it come from, means to gradually kill this initial starting loan balance. And in order to do amortization, so for calculating interest, you really just need two pieces of information. You need the interest rate, the APR that we just figured out there. Let's go ahead and rewrite that. You need your starting loan balance, the amount financed for whatever it is that we're starting the calculations with here. And you do need a third number. And we already kind of used an example of that in the previous example here. But the third number that you need is the payment amount. So you need the loan balance, you need the APR, and you need the payment amount. These are the three things you need to amortize a payment. And let's say that our payment's going to be $700. So you need these three variables. If you don't have these three variables, you don't have enough information to amortize your loan. You can do some kind of calculations and sub in some of these numbers, but ultimately you need these numbers: the loan balance, the APR, and the payment amount. And if you're watching these videos to study for your real estate exam, this is a very likely question to come up of how to amortize a mortgage. What's the first month, or the second month, or the third month's payment towards the principal or interest payment? And if you understand calculating interest, there's a few more steps. There's a little bit more work involved for calculating out the payment amount, but overall it's really not that more difficult. So let's do a new example here, and let's pick out some numbers for this. So let's say that we've got a loan balance, let's say $250,000. So we've got a $250,000 loan balance. Let's say that our APR, our annual percentage rate, or also sometimes just simply called the interest rate, let's say that that APR is 5%. And let's also say that our monthly payment is, let's say, about $1,200. So we've got our three variables that we need to solve this year. We've got our loan of $250,000, we've got our APR of 5%, and our payment of $1,200. If you're taking one of these questions on the exam, then these are the three things you need to pull out first and foremost: the loan amount, the APR, and the payment amount. Now, once you have those three pieces of information, you now need to know what it is that you have to do with these pieces of information. So what you're going to start off with is, number one, calculate the interest. So step one, always calculate your interest. And that's that math that we just did, that we just figured out. If you could do that, you can complete step one. Now step two is calculate the principal payment. And this one, we actually already did as well. It's very simple. It's just taking your total payment amount, the $1,200, and subtract out whatever your monthly interest is. And then finally, number three, now if you're just trying to find out for that 1 month that you're dealing with there, the current month, the first month of the mortgage, whatever it may be, if you're trying to find that one single month of how much you pay towards interest and how much you pay towards the principal, you're basically done there. But for the exam, they're typically asking you at least 2 months out, sometimes even 3 months out. So what you need to be able to figure out now, and like I said, when you pay on the principal, that word principal just means the loan. So you have your interest payment. The interest payment is the money going to the bank that the bank makes off of this. That's their profit and cost of giving you this money. And the principal or loan payment is how much is actually decreasing your balance. So if we start off with $250,000 and we have a principal payment of $500, we're decreasing that by $500. And that brings us to our third step, which is calculate new balance. Because every time you make a payment and this information gets recompounded, we start all over. We go every single month. Month 1, month 2, month 3, month 4. So this is a lot of calculations. And you go online, you go to Google or any of these websites like that, and you could just search for amortization calculator, and you just plug in the numbers, and it does all these calculations in the blink of an eye, much faster than we could do them here on the show. And if you're studying for your exam, the downfall is that you don't have access to those tools. You don't even have access to a financial calculator. You get a regular calculator, but that means you got to do these calculations the old-fashioned way. They're not really difficult calculations, but you do want to remember these steps. Number one, you find out what the interest is, how much that interest payment is for a single month, not a year. You want to remember that it's just a single month we're dealing with here. Our second step is calculating our principal payment, which is going to be also fairly easy. That's taking our loan balance and subtracting out how much interest we paid to the bank, because the bank gets paid first, and whatever's left over is how much we're going to decrease our loan. And then finally, we figure out what that new loan balance is, because month 1, our bill says $250,000 is our balance. Month 2 is going to say a smaller number than that, as long as we're making some principal payment. like I was talking about earlier, if we're only paying interest, if this is an interest-only loan where you're only paying the interest on it, that means this number never decreases. But the second you pay a penny more than what the interest is, this number is going to decrease month after month after month, even if by only a small amount. And what you typically see with amortization is it starts out where we'll do two colors here. We'll have our high dollar here and low dollar here. So we've got our green, which is our payment on the principal. So this is going to start off very small and grow as time goes on. Now, we have the same amount of payment every single time. So our total payment might be here for the entire life of the loan. We might have this as our entire payment, and so what that means is starting off, you're paying almost all interest. So that's your interest payment. And this one down here would be your principal payment. At the beginning of the loan, let's say we look at this first payment, you have a very small amount of principal, very large amount of interest it is that you're paying out of that total dollar amount up here of your loan. And then on the opposite end, when we get towards the end of the mortgage, it flips. And the amount that you're paying towards your interest, very small, and you're making a very large principal payment. And you might be watching this and say, oh, well, the system's rigged because, most people aren't going to live in their homes for 30 years or for 15 years or even if this is a 10-year loan, but most mortgages are 30 years. So most people will never get to this point. And you're right. I mean, the banks are loaning you a significant amount of money. You think of how many people wouldn't be able to afford the home it is that they live in without the financing that's available. And they price that financing at a premium. But this is just simply how the compounded interest works. And the reason why is we have our balance here. We'll do our balance in blue. So our balance would start off, and this isn't to exact scale here, our balance would start off very high, and it's basically going to decrease at the rate that our principal decreases. So our balance is only getting very smaller to begin with, and every time the balance gets smaller, our interest payment gets a little bit smaller as well. So we're continually having a smaller and smaller balance until we start making bigger chunks on that. We're constantly paying that same $1,200 or whatever that payment may be. That's called a level payment plan mortgage. A level payment plan mortgage means your payment is the same month after month after month after month. But what happens is the composition of that payment changes. You start off paying, again, almost all interest. At the end, you're paying almost all principal. Now, we're going to take a quick commercial break, but when we come back, we're going to plug some numbers in this, do some real-world examples of calculating this. So get an understanding. We're going to use this formula right here and work that through these steps. So stick with us. If you have questions, put those in the comments. I'm John Chrismo. You're watching Ask the Instructor. Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Did you know that if post-licensing education isn't completed by your first renewal, your real estate license will become null and void? If your license becomes null and void, you must restart the licensing process all over again. At the Tampa School of Real Estate, we make renewal requirements easy. Visit postflorida.com to learn more and enroll today. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com. Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo. The show is brought to you by the Tampa School of Real Estate. If you're thinking about starting or enhancing your career in real estate, give us a call. Phone number is 813-928-0106. You can also check us out online at tampaschool.com. And we also got our recommended strategy to pass your exams on the first try at passfirsttry.com. So make sure you check those out. What we're talking about today is, number one, calculating interest and understanding what that interest is. But now we've kind of progressed into, now we're not just calculating interest, we're amortizing a mortgage. That's what this is called, amortizing a mortgage. And if you guys already took the pre-licensing class with us, this probably seems familiar, and I definitely should, because we definitely do calculate lots of different mortgages in the course here. So let's now plug in these numbers. Let's do the math and find out for this loan what it is that is going to be our payment towards interest and payment towards the principal. So we're going to erase these steps real quick here, and we're just going to go ahead and fill in the numbers now as the steps. So our first step was calculating interest, understanding what the interest is. And that's the first number you want to find out, because who gets paid first? The lender. You short the bank at all whatsoever in your mortgage payment. First of all, they're not going to be happy about that. They might just go and try to foreclose on you right then and there. But if they do make any sort of terms for you, they're not cutting their interest. They're charging you. You're just going to get a cut on the actual principal payment, it may be. So the interest always gets paid out first to the bank. And that's why we calculate this first here. So what we do is take our loan of $250,000. And we're going to, again, just calculate interest, just like we did before at the beginning of the show. $250,000 times 0.05. And we plug that in our calculator. What's that going to be? Maybe 10,000? Oh, close. 12,500. So our loan amount, what we just did there, we took our loan amount of $250,000. That was our loan. We multiplied it by the APR as a decimal, so you're just taking that 5% and just moving 2 decimal places over to make that 0.05, and that gives us $12,500, but remember, that is the APR. And remember what that A stands for. The A stands for annual. So that's our annual rate of interest, but we're not making payments annually, we're making payments monthly. So what we need to do now is break that down into a monthly number. So in order to do that, we're just going to simply divide by 12. And when we take that now and divide that 12,500 divided by 12, we're going to end up with an interest amount of $1,041.67. So, and this number I like to put right here in red, because that's our month one, so M1, month one, interest payment. So in month one, we pay $1,041.67 in interest. And you might be saying, John, is that right? Are you sure that it's $1,041.67 in interest? That seems like a lot, especially considering that our payment on this mortgage is only $1,200. And yes, that's typically how this works here. So remember that chart that I had there, the first couple months, the first couple years, the first really almost half the mortgage, and even sometimes after that, the lender's the one that's ultimately making all their money up front. And then on the back end, that's where you're able to finally start making big chunks in the payment. And we're going to show why just when we get into month two here. So our second step we need to calculate here is, now what is our payment amount? We figured out how much money the bank's going to get in interest, but now how much are we decreasing this $250,000 by? Again, that was our starting balance. That was month one. And then when we're going to figure out what month 2 is, month 2 isn't going to have the same $250,000 there. We paid $1,200, and the bank took most of that money in the $1,041.67, but they didn't take all of it. And that money that's left over out of your payment when we subtract out that interest amount, that's our principal payment. So our second step is calculating the principal payment, calculating how much we're decreasing the $250,000 by. So we're going to take the $1,200 and we're going to subtract from that $1,041.67. And what we're going to be left with $1,200 minus $1,041.67. We're left with $158.33. And this is our month 1 principal payment. So just going through what we've got so far here, we've got the money going to the bank. That's our $1,041.67. And then we've got the money that decreases our balance, the $158.33. That's our principal payment. And the questions, if you're studying this for your exam, the questions will use the terms the interest payment or the principal payment. I would venture to say they're probably going to ask you about principal payment because it's making you go through that extra step to get to this number. So that's probably more likely what they're going to ask about. But they could also ask about the interest as well. Totally up to them. They might want to just keep you on your toes, which they do a good job of doing that. So again, this is our interest, money going to the bank. This is our principal. That's the money paying down this $250,000 balance. Now remember our third step. Our third step was finding out what the new balance is. Because if we never decrease this $250,000, again, let's figure it's interest only, that number is going to stay the same as long as we have the mortgage. But since we just made $158.33 as a payment, that might not seem like a lot, but the compounding is going to be what eventually turns this into where our payment of $1,200 is almost all principal instead of in this case here where it's almost all interest. You get to year 30 on this mortgage, and this number is now, these numbers are going to be flip-flop. This is going to be your principal, the $1,041 or some number close to that. It might not be exactly. And then your interest is going to be the very small numbers. But when you start off with, again, the banks make their money up front. So our third step, again, figuring out what that new balance is going to be for month number 2. And this is very simple. All you're doing is just another little bit of subtraction is $250,000 minus that principal payment. So we're bringing down that principal payment here, just like up here we brought down our interest payment here. So you bring down the interest there. This one we're bringing down our principal. So we've got $158.33. That was our principal payment. And so that means that our new balance for month number 2, $250,000 minus $158.33. Our new balance for month number 2 is $249,841.67. So, big decrease. Not so much, not when we're speaking about a $250,000, but when this occurs over 30 years, you're going to have these smaller payments up front where it's just $158.33 or whatever that may be, and it's going to have these small impacts on whatever your outstanding balance is on that loan. But now, month 2, the reason why this number is going to get bigger and this number is going to get smaller is because in month 2, we're no longer basing our interest off of $250,000. The interest that we're being charged is based off of our new balance of $249,841.67. So what we're doing essentially, we're going to replace out some of these numbers here. This one, it's what our calculations equate out to, so we're going to go ahead and take those out here. But other than that, we're just repeating these steps. And notice what I'm strategically erasing here. Didn't mean to erase our equal sign. And then step 3, we're going to have to do that all completely over. It's going to all basically change. But what we're changing, it's the most important one here, is we're subbing in that $250,000. In month 1, our outstanding loan was $250,000. Now our outstanding loan is $249,000. $12,841.67. So that's our new balance for month 2. And now at this point, we have to, again, multiply that by 5, and we'll just go ahead and skip, save some space here. So multiply by 5 and divide by 12, because again, when we just multiply by 0.05 by the 5%, that's our annual number. When we divide that by 12, that ends up giving us our, this is now going to be month 2 interest. And then once we do these further calculations, we'll also end up with month 2 of principal payment. So we're going to go ahead and plug these numbers in here. $249,841.67. That's our new balance for month 2. We get the bill for our mortgage on month 2. That's what it says is our outstanding balances, how much we have left on this balance. We're going to take that number again, multiply by 0.05. That gives us $12,492.08. So a little bit smaller than that $12,500 we had in the previous month. And these numbers should always go down. That's a way you can check yourself, make sure you're not wrecking yourself, make sure you're doing all the math correctly. And then we're just going to go ahead and divide by 12. Take that number, just hit divide by 12, and our month 2 interest payment is now going to be $1,041.01. And you might say, John, wait a minute, it was $1,041 before, it's still $1,041. Yes, it is, but remember, it's just small decrease. So we did go down, but we only went down, what was it, maybe 40 cents, something like that. So there is still a decrease. We are doing the math correct, but it is a very small decrease, and that's how amortization works. And this could vary based on the interest being charged. If our interest was lower, then we'd have a lot more money going towards the principal payment out of that same $1,200 it is that we're paying here, which ultimately makes it so your home buyers can afford more home, which that's definitely helpful there. Got a question coming in from Ismar. What is the definition of amortization? So Ismar, thanks for sending in the comment. So amortization basically means to gradually decrease. What we just did there, and if any of you guys are kind of thrown back by what do you mean it's only going down from 1,041 and what was that, like 60 cents to 1,041 and 1 cent? But that number is going to continually getting smaller and smaller at a much larger rate. That's what amortization means. Amortization means that we're gradually decreasing this $250,000 little by little, by a little bit more, by a little bit more, by a little bit more. Then all of a sudden we have these payments. This $1,200 at the end of our mortgage is going to be basically completely almost obliterating our loan balance now in the last few years. But in the first few years, the bank's making more money than they know what to do with for the most part. So that's really what amortization is. Great question on that, because understanding the words here will help you understand why we're doing this math and why the math looks a little bit that way. And again, if any of you guys have questions, feel free to stick those in the comments. Love to answer those for you. So we've got our month 2 interest payment. Again, this is how much money is going to the bank. So what we're going to do now is take that number. We're just going to basically plug it in. We're carrying down this interest right down to there. So we've got $1,200. That's how much we're still writing a check, or it's still debiting our account for $1,200. That number doesn't change. This payment is always the same. The interest rate, the APR is always the same. This number is going to go down every time you make a payment, the loan amount. So our payment, that's a constant. That never changes. So we're taking that $1,200, that's how much we're always making the payments for as long as we have this mortgage, and subtracting out $1,041.01. And yes, there are mortgages out there where the payment can change. There's lots of adjustable mortgages where that does change, but when we're dealing with a level payment plan, fixed rate mortgage, very basic, that is a constant for us. So here we've got $158.99 as opposed to $158.33. So we went up by, what's that, maybe about 60 cents or 64 cents or so? No, 66 cents. So yeah, we went, we've paid an extra 66 cents this month, but that now is going to decrease from this here. So just erase step 3 completely there. Let's go ahead and fill in our $158.99. I'm writing these in the wrong spots here. Just want to make sure you guys can follow there. We're supposed to just carry that down. So the 1,200 minus the 1041.01 gives us the 158.99. And then step 3, again, this is calculating what our balance is. And now we're up to month number 3. We did month number 2. That was our new balance for month number 2. Now we're going to find our new balance for month number 3. And the way we do that, again, we take our balance, but we're not taking $250,000. That was our balance for month 1. We're now on to month number 3 that we're finding the balance for. So we're taking month 2 balance, $249,841.67, and then we're just subtracting out that $158.99. So we plug that in our calculator, $249,841.67, and we subtract out from that $158.99. We end up with $249,682.68. And that's as easy as it is. Once you have these 3 steps down, that's our month 2 balance. And again, it's important to know what these words are called. That's why I was glad that Mary asked about what that word amortization means, because it is important to know these terms, especially if you're studying for your exam, because the exam could ask what the interest payment is for a certain month, and this one was month 2. It could ask what the month 2 principal payment is, or it could ask what our month 3 balance is. This is our month 3 balance. We started with month 2 balance. Once we went through and did this amortization, we now have the starting balance for month 3. And you might ask, oh, what will happen in month 3? Well, why don't we find out? Let's plug in these same numbers again. So again, we're going to start here. We're going to change out that number. We're going to change out the $158.99. Our $1,200 is going to remain the constant down there. And essentially what we're doing is taking that $249,682.68 and plugging that in up here. So our new balance, again, month 3, we get our bill. It's going to be $249,682.68. And we're doing the same math all over again. We're taking that new balance, so it's just a matter of just replacing these numbers and knowing what these steps are. And overall, this is a pretty easy calculation to do. So we take $249,682.68. We multiply that by 0.05. We divide that number now by 12, and now our payment, we've gone down, we're into 1040 now, so $1,040 and about, we'll round that to 34 cents. So $1,040.34, and that's our interest. And you can see it did go down. It did go down at a little bit faster rate this time, and it's gradually picking up. It's gradually picking up steam. It starts off moving really slow, and then it gets going, and then that's when you're really making a decrease in your actual mortgage balance. And that's what that word amortization means. It means that we're having a gradual decrease over time. So we're just going to carry down that number. We're taking our payment of $1,200 and we're subtracting out how much money goes to the bank, because again, the bank gets paid for first, and that's the $1,040.34. So when we plug that in our calculator, $1,200, that's our monthly payment, $1,200 minus $1,040.34. We end up with now a principal payment. We've finally kicked up to the next dollar, $159.66. So we went up by about 67 cents in this payment here, as opposed to 66 cents in the last payment. And now, if we want to find our month 4 balance, our last step for this year, we're going to again now take our $249,682.68. We're going to go ahead and subtract out that 159.66. And that means for our month 4 balance, $159.66, we end up with $249,523.02. And that would be our month 4 balance. And this continues on and on and on and on for 30 years if that's the term or the time period of our mortgage, or 15 years if that's the term or time period. This will go on as many times as this needs to be done to basically fully amortize or fully decrease, fully kill off our mortgage. So we get down to a month number, what is it, 360 is 30 years across 12 months, so month 360, this balance should end up being 0 at the end if it is fully amortized. If you have money left over, that's called partially amortized, and now that money is due as what's called a balloon payment. So that's the amortization. Now there's a few more things I want to cover before the end of the show here. We're going to take a quick commercial break, but stick with us because I've got some last few important tips about this for understanding this in the real world, as well as in case you see this on your exam. So stay with us. I'm John Chrismo. You're watching Ask the Instructor. Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Did you know that if post-licensing education isn't completed by your first renewal, your real estate license will become null and void? If your license becomes null and void, you must restart the licensing process all over again. At the Tampa School of Real Estate, we make renewal requirements easy. Visit postflorida.com to learn more and enroll today. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com. Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Kurtzman. This show is brought to you by the Tampa School of Real Estate. If you're thinking about starting or enhancing your real estate career, make sure you give us a call. The phone number is 813-928-0106. Our advisors are standing by to answer any questions you have and assist you in any way it is that they can. So make sure you give us a call. You can also text us if you're into that kind of thing, which most people are these days. Quick tip for you in the real estate world as well. And also check us out at tampaschool.com. That's tampaschool.com. We've got loads of information on there. You can go to our Success Center. We've got all of the Ask the Instructor episodes, all of our State of Real Estate episodes, a lot of helpful articles and other videos to really help you understand everything it is that you could possibly ever want to know. What we're talking about today on this week's episode of Ask the Instructor, because on Ask the Instructor, 12 noon every Wednesday, we come to you live to help you understand the real estate industry. And what we did today was amortization. Now, there's just a few things I want to touch on with this amortization here, because you can see there is a lot of calculating, there's a lot of crunching numbers with this here. But overall, once you know the steps it is that you have to perform, and especially when you understand the steps, that's why I spent so much time explaining the interest and what the significance is of that interest concept and what that principal concept is, and explaining that significance of that, because when you understand that, it makes knowing these steps a lot easier. Now, a couple things I want to leave you guys with just to make sure you don't make some silly mistakes on this or anything like that. When we're talking about these numbers up here, so first one I want to touch on here is this loan amount. So the loan, this isn't necessarily the purchase price on the property. It can be in certain circumstances. We have what's called a VA loan where it has, so there's a number I want to give you guys real quick called loan to value. So loan to value is the amount of loan out of the value of the property. And really, anytime you see a ratio, something to something, that just means loan divided by value. When you see anything to something ratio, just like, for instance, this one you probably see on the road all the time. I hope you see it on the road all the time. Miles per hour, that also means something divided by something. That's what per means, that's what to means. So it's a real easy understanding the formula of what loan to value is. It's our loan amount divided by our value. And there can be situations where your loan is, let's say we've got a $250,000 loan and we've got a $250,000 value, If you do that quick calculation, 250,000 divided by 250,000, you'll get 1.00, which as a decimal, when we move that over 2 decimal places, you end up with 100%. That would be 100% loan to value. The types of loans that offer 100% loan to value are VA loans. There are some, if you want to get creative and you got a creative enough lender, you might be able to get a 100% loan or something close to that with a non-VA loan. But for the most part, the VA loans are the only ones where you can pretty much always get a 100% loan to value. And even in some circumstances, you can't do that. So that's our loan to value. Now, like I said, that's not always the case. If you're a veteran and you're getting a VA loan, then absolutely, that could definitely be that way. But in most cases, the loan is a smaller part of the value, and we end up having a smaller percentage for that loan to value. Let's say that this property is valued at $300,000. So if it's valued at $300,000, we're going to take that $250,000, divide it by $300,000, and we end up with about 83%, 83.33%. Now you'll notice when that came up on the calculator, that was just 0.83333333. And again, we're just moving that 2 decimal places over to turn that into a percentage. So 83.33% of roughly about 83% would be our loan to value here. So what that means is if you're doing this on your exam or you're trying to do amortization in the real world, the key thing is this is not based off of your value. It's not based off of your value. It's based on the loan amount. And that's a big mistake I see a lot of people make, especially on the exams, is the question will say, okay, we've got a $300,000 value. We've got 83.33 is our loan to value ratio, and then amortize this out. You don't want to just plug in that $300,000 like it's the loan, because that's not the loan. That's going to be how much the property is worth. The loan amount is the only number it is that we care about in amortizing a mortgage. So just in case you see something like that, you have to remember to factor in the loan to value. But that's pretty much all the stuff I've got for you guys today. We're coming right up on this hour here. I hope you guys have enjoyed this episode. Looks like we got one more comment here from HS on YouTube. Thanks for tuning in, HS. And we'll take this one real quick before we tune out here. What is a balloon payment? So the balloon payment, this is, like I said, when we've got this chart, and we've just got this simple chart. We've got year 0 here, we've got year 30 here, if this is like a 30-year mortgage. And what happens is your balance is going to get smaller and smaller and smaller and smaller till year 30, you owe $0, to where you get down to not owing any money at year 30. That's called a fully amortized mortgage. So fully amortized mortgage, you get down to year 30 and you have no balance remaining. Now, with where you might have a balloon payment, that's what's called a partially amortized mortgage. So what you're doing in a partially amortized mortgage is you're not paying enough to get to year 30 and have no balance. So what happens is you're paying, but year 30, you're not down to 0. Let's say you still have $10,000 as your outstanding balance at the end of year 30. The balloon payment is the bank saying, hey, $10,000, let's go. Your mortgage is over with. Your final bill is going to say $10,000 instead of whatever that payment was for you. So the balloon payment is when you have a partially amortized or partially decreased mortgage. You get to year 30 and you still owe money. That money that you owe is called a balloon payment. So hopefully that helps you out in understanding that stuff here. That's what we're here to do on Wednesdays, help you guys understand the real estate industry. Thank you for tuning in. Thank you for liking. Thank you for subscribing. Thank you for commenting. If you haven't gone and checked us out on YouTube, we've got a ton of videos on there. We've got over 83,000 views on our YouTube channel, so make sure you check that out. There's 83,000 people that have seemed to found some interest in it, so I'm sure you will as well. Go on Facebook.com/Tampa School. We're always posting helpful stuff about the Tampa Bay area, about the real estate industry, and also check out tampaschool.com/success. That's where we've got kind of our central hub for all of this information, the one quick, easy point to go to for everything it is that you need. So definitely check that out. Thanks for tuning in, and I'll see you guys next week for next week's episode of Ask the Instructor. Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Did you know that if post-licensing education isn't completed by your first renewal, your real estate license will become null and void?
If your license becomes null and void, you must restart the licensing process all over again. At the Tampa School of Real Estate, we make renewal requirements easy. Visit postflorida.com to learn more and enroll today.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com.
Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor.